Hey there, market mavens! Welcome back to the channel where finance meets fun. Today, we're cracking the code on stock market indexes. By the end of this video, you'll know your Dow from your NASDAQ and your S&P 500 from your MSCI, all with a few laughs along the way. Ready? Let's dive in. Hey there, market mavens! Welcome back to the channel where finance meets fun. Today, we're cracking the code on stock market indexes. By the end of this video, you'll know your Dow from your NASDAQ and your S&P 500 from your MSCI, all with a few laughs along the way. Ready? Let's dive in. First things first, what exactly is a stock market index? Think of it as a scorecard for the stock market. It tracks the performance of a group of stocks and tells us whether the market's having a great day, a bad day, or an I'll get back to you kind of day. Indexes are used by investors to measure market trends, make decisions, and sometimes just feel smarter at dinner parties. Trust me, saying the S&P 500 is up 2% makes you sound like a financial wizard. Not all indexes are created equal. Let's meet the key players. Broad market indexes. These cover large portions of the stock market. The S&P 500, for example, tracks 500 of the largest companies in the US. It's like the A-list of the stock market. Sector indexes. These focus on specific industries like technology, healthcare, or energy. If you're a tech enthusiast, you'll want to keep an eye on indexes like the NASDAQ 100. Global indexes. These track international markets. The MSCI World Index, for instance, lets you see how stocks are doing across the globe. Think of it as the stock market's version of Eurovision, but with fewer costumes. Small cap and mid cap indexes. These focus on smaller companies with big growth potential. The Russell 2000 is a popular one here. Bond and alternative indexes. Not into stocks? There are indexes for bonds, commodities, and even cryptocurrency. Yes, Bitcoin has its own scoreboard too. Indexes aren't just random collections of stocks, they're carefully weighted. Here's how it works. Price-weighted indexes. These give more importance to higher-priced stocks. The Dow Jones Industrial Average, Dow for short, is a classic example. But remember, just because it's pricey doesn't mean it's more important. Market cap-weighted indexes. These are based on the size of the company. Bigger companies like Apple and Amazon have more influence. The S&P 500 is king here. Equal-weighted indexes. Every stock gets an equal vote, no matter its size. It's like the democracy of stock indexes. Why do indexes matter? Let me break it down. Benchmarks. They help you compare your portfolio's performance. If the S&P 500 is up 10% and you're up 15%, congrats, you're beating the market. Passive investing. Index funds and ETFs allow you to invest in an entire index. It's like buying the whole buffet instead of just one dish. Market trends. Indexes show us how different parts of the market are performing. Whether it's tech booming or energy lagging, indexes keep you informed. Economic indicators. Indexes can also reflect the health of an economy. A rising index often signals optimism, while a falling one might mean it's time to tighten the budget. Let's take a quick world tour of famous stock market indexes. Dow Jones Industrial Average, USA, tracks 30 big-name companies. It's old school, but still relevant. S&P 500, USA, covers 500 large companies and is the gold standard for US investors. NASDAQ 100, USA, tech-heavy and home to giants like Apple, Microsoft, and Tesla. FTSE 100, UK, the top 100 companies on the London Stock Exchange. Nikkei 225, Japan, tracks 225 top companies on the Tokyo Stock Exchange. MSCI Emerging Markets focuses on developing economies like India, Brazil, and China. Investing in indexes is easier than ever. Here's how. Index funds and ETFs. These are funds that track an index. They're low cost and diversified. Robo-advisors. These automated platforms often use index funds to build your portfolio. It's like having a financial advisor, but without the coffee breath. Direct investing. If you're adventurous, you can pick and choose individual stocks from an index, but remember, it's like trying to bake a cake with only the ingredients, no recipe. Before you dive in, let's cover some common pitfalls. Ignoring fees. Some index funds charge high fees. Look for low-cost options to maximize your returns. Overloading on one sector. Diversification is key. Don't put all your eggs in one tech-heavy basket. Timing the market. Index investing works best when you stay the course. Trying to time the market is like predicting the weather with a coin toss. And there you have it, everything you need to know about stock market indexes. Whether you're investing for growth, stability, or just to sound impressive at parties, indexes are a powerful tool. If you found this video helpful, give it a thumbs up, subscribe to the channel, and share it with your friends. Remember, the stock market is a roller coaster, but with indexes, you can enjoy the ride without losing your lunch. Until next time, happy investing, and may your portfolios be ever in your favor. Cheers!